Hi, let's talk about Socket Market. It's a company that produces data captures products for mobile application used in business mobility markets in the United States, Europe, Asia, and internationally. Market cap is 41%, and based on simple Wall Street is not meaningful. Shareholders have been dolled in the past year. Volatile share price over the past 3 months, and also earnings have declined by 58% per year over the past 5 years. Still, Snowflake Analyze shows that health is 6 out of 6, and we will be back to check this on later. Latest share price. So there was some of the product updates and shelf registration, so they are printing more shares out, and at the same time they dilute the shareholder. Market performance: 1 year return almost 300%, outbids the industry, same as the market. Long-term price volatility considered as less volatile than the average market volatility, and actually industry itself is more volatile than the average market. 3-year return 132%, 5-year return almost 192%. Valuation side, based on simple Wall Street, fair valuation should be around 150, and TipRanks does not have any price targets. MarketWatch has 7.75, so in both cases there is a downside. If we look at the Finviz, it actually did in 1 day till highest point 14.7. We see here that in mid-February, 16th of February, it has highest point of that day, $35 per share. Huge volumes were there, and also they are growing as well as today. Anyway, the future growth for the tech industry is currently forecasted only 3%. Past performance of the company, historical annual earning growth decreased by 58%. Basically, they had super profitable years, 2017, 2018. There was, with the revenue 21 million and earnings 11 million. So there's a huge profit margin. So that is declined through the years, and currently the company is unprofitable. Financial health side, so there's a little bit debt that they have, 2 million, and let's check the cash. Yeah, so there's basically very good. The cash level is well covering the debt almost twicely, and they do have equity, 14 million, cash almost 5 million. Debt to equity ratio is 16%. That is considered satisfactory. I'm not sure where they need the cash. So there's actually, they printed their shares out, but is it because they took a little bit depth since the last earning update? Maybe that's why. And also they raised some of the equity. Balance sheet looks green. There's a little dot on the corner of showing the depth, 2.3 million. They are not paying dividends and insider transactions. Yeah, so there's actually 2 sellers, not a significant of amount, $3,000 and $17,000. Last transaction were on May 17th. Ownership breakdown: general public holding 74%, insiders 20%, institutions less than 5%. Top shareholders, we see Vanguard Group is adding 34%. Do we see here, for example, BlackRock or some of the similar? Gauge Capital is here. So we see that there's on both sides. Renaissance Technology Corporation decreased by 41%, and there's on the top insiders holding mostly. So there's many insiders, and also members of the board and so on. Anyway, the stock price is highly volatile. That means that the current level could drop to previous levels, for example $5 per share, maybe to last year's numbers, 2.5, 2.6 or so. Simple safe dividend shows that shares outstanding a little bit increased. Basically they have this ability to decrease the shares from the outstanding, but currently basically last 12 months they increased compared to previous period. Total sales are volatile. They actually last 12 months they decreased by 14%, and last year they decreased by 18%. And that is the volatility that could affect on the stock price. And yeah, this actually is showing the 1-year return, currently 521%. On the simple Wall Street, they're shown basically through the previous day close. And if we take a look at the 5-year return, 212%, and max size, this is actually very important information, it's minus 85%. So there you see the profits that it had in 2000. So there's a dot-com crisis, and now I believe why it happens. There's over 3,000% in just a short period of time. Yeah, that is actually huge. Those who invested in the peak are, yeah, they basically minus 100% almost. That is the unlikely situation that could be in any stock pretty much. So that's why be careful, guys. Try not to invest all money in one stock. Try to a little bit do some of the diversification. And if you brought, for example, on the peak, you see you're down 50%, you can diversify by time if you believe in company. So once it's up down 50%, you can buy there. You can buy, for example, if it is going down, just you can lower the average of your share price. And once you're averaging so much that it going up someday, you can profit from that. But anyway, if the share price is highly volatile, such as this, there's in one day almost 600% of the return, and that is on the close. So actually on that day it has had $35 per share. Yeah, 608%. So basically, if you have been averaging it all the time, you could profit from that. But try to diversify by industry, by market cap, by time, and so on. That lowers a lot of the risks. And investing.com summarized this stock for long-term investors as a strong buy. Thanks for watching this video. Subscribe to the channel, like the video, and see you in the future one.